Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview. I'm delighted today to be joined by Jamie Webster, who is partner and associate director at the BCG Center for Energy Impact. Jamie, thanks so much for joining us today.
Thanks for having me. Really looking forward to talking to you all.
Well, great to have you, and we have a lot to talk about today. Let's start with getting your take on where the oil price sort of forecasting has how it's played out really this year in terms of the expectations, not so much of the price, but where demand has gone and how that may have impacted obviously participants in the market. We had a pretty weak April for oil prices, relatively speaking, following a cut by OPEC, which came in to support the market. So why do you think that happened? Why is that happening?
Yeah, so the one, you had the surprise cut, you had all these expectations. So I think a lot of people, and we had, if you recall, at the beginning of this year, many of the big forecasters were saying, $100, $120, all of this sort of stuff. And now we are down in the 70s. And so it's the question, you're asking exactly the right question, which is, what is exactly going on here that is happening, that is where we have these kind of two different stories. And I would say what it really comes down to is a concern about the global economy. And is the global economy actually going to start to slow down, even as we're getting almost every data point that we're getting is like really strong growth. So the US just had our latest job numbers, I think 241,000, well above expectations. Several China data points have come well above expectations. We'll get another one next week when we see with their industrial production, which is one that I'm really watching to try to understand what's going on there. But there is a narrative, and if you look at kind of a Google Trends search, it's interesting in that the search and the looking at recession is 2 to 3 times higher than it was in the great financial crisis. And so there's this narrative that it's like many, many times worse, and yet the data is not supporting it. And I think that is kind of what is dragging things down, because you've got a lot of data points that show quite bullish indicators. You've already mentioned the OPEC surprise cut. Obviously, OPEC will be meeting again June 4th, but you've also got that longer term narrative of there hasn't been enough investment in oil and gas relative to the still growing demand that we have. So we did some research, and we saw that the amount of investment that is happening is as if oil demand had already peaked. And of course, as we all know, it hasn't yet peaked. And so you've got that longer term sort of scenario and that longer term narrative. And then, of course, the one data point that we've all been looking for last year as China was going through its COVID zero policy, which is China's return, and how strong is it going to be? And there's been some really strong indicators. Jet fuel demand finally popped up. So you're seeing finally, we've been tracking since COVID a recovery in data points. And jet fuel, while it hasn't quite recovered back to the pre-COVID levels, the number of flights has recovered, and that has been driven by China. And I think you're going to see some additional strength out of China over the next couple of months. And so it really is this kind of story of, it appears that the economy is going actually quite well right now, but of course, it's always hard to kind of figure out what's going to happen over the next couple of months. And I think that's kind of the focus, is this narrative that things are about to turn down and south.
Yeah, and as you said, the narrative which is kind of impacting those sort of short sellers, let's say, who are in the market, who came in the market, who are nervous because of the financial situation. They have the banking crisis, quote unquote, in the US, which continues to sort of unravel. You have the debt debate, obviously, that's still going on, and most people are assuming some last-minute solution agreement will come to that. But let's just stick with China a little bit, because yes, it did have a pretty strong first quarter in terms of oil demand, certainly still filling up its coffers, its inventories of oil. But do you subscribe to the sort of belief that it was a bit stronger a month ago than it is today? that we will actually see a real uptick, as you said, in industrial activity. The property sector will begin to recover, and even consumer spending. We might start to actually see some of that in China in the second half of the year. If we see that, will that give a big lift?
I think if we see that, and so the data point next Monday that will be coming out, which is looking at industrial production, that will help. Later on today, as we're recording this, but by the time your viewers are seeing it, they will have the data point on what is going on with the balance of payments, because that's going to be important, is trying to understand how much there was. Last time it surprised a bit to the upside in terms of imports, but it had, if you looked at their exports, it didn't shoot up quite as much, indicating that maybe downstream demand for Chinese products was not there as much. And so those are going to be really important, and also trying to understand how much push is the Chinese government going to push into the economy to make sure that it has that kind of big pop of growth. Certainly in the United States, we had a lot of money that was injected into our economy that helped, some pretty short-term growth, but now we're kind of having to pay our way through that. And get through that system. But China, you're exactly right. China, it really is the story this year. And interestingly enough, it is the story for oil. It is also the story for natural gas. Understanding where China is, if you know that, you have your year set for your trading.
Yeah, absolutely. Okay, so that's demand. But what about supply? And of course, China is a supplier of products into the region as well. But let's talk a little bit about the supply angle. We mentioned OPEC is cutting more production. It may come in and pledge more cuts in the beginning of June, depending where the market's at. Russia, let's talk a bit about Russia and sanctions that have been placed on it. We know what the sort of restructuring of its flows has been so far in terms of crude and products. Do you see that new pattern and trend definitely continuing, further, as long as the war, all else remains the same? Or do you see a disruption to that potentially?
I see most likely, and this is a difficult question, but I see most likely this is going to be a more permanent sort of shift. So you're seeing, of course, the additional Russian flows down to India, and they are probably going to build up a bigger trading relationship. So this will be a bit more of a permanent sort of issue. So some of the flow changes that you're seeing, you're going to end up, effectively creating wheel tracks. And that's going to deepen the market in those sorts of channels, and you're likely to have some greater permanence for some of those flows. Speaking with clients in Europe, there's a real recognition as you move kind of up the chain and talking with the policymakers that it's like we really want to protect ourselves and not get, to use the term, over our skis in terms of dealing with Russia in the future, as we did in the past. And of course, the kind of real story for that is Germany believing that it could really just have an interdependent relationship with Russia as it relates to natural gas, and didn't look at bringing in FSRUs or other sorts of things. And I think that's been a lesson that has been learned, which is trying to make sure, do we have a reliable supplier? And the kind of old places that Russia sent stuff, they're having some questions, but now Russia has an opportunity in places like India and other, in the global south, where they could potentially find homes for their crude.
Absolutely, but of course you also have the gas side of it, and Europe made huge efforts in the last year to sort of again start its sort of more independent track, and of course it was okay this winter because of weather, because of gas supplies, etc. And by all accounts, it seems that they're quite sort of comfortable going into the next sort of winter cycle, barring any other bigger surprises. Let's talk a little bit about those flows, but in the context of the geopolitics a bit, Jamie. I mean, China obviously being one of the biggest takers of Russian crude since sanctions were put on the country, and has benefited obviously greatly from that, India being another. China also is beginning just to play a bit more of a sort of role in the geopolitics of the new energy order, if you like, as people are calling it. One of those roles was to choreograph a handshake between Iran and Saudi Arabia recently, who knows who choreographed it, but China was being seen to be doing it. Give us your take on also the Gulf producers, Saudi, Iran, where that sort of rapprochement is going in your view from what you hear, and how that may be impacting the energy markets or the sentiment in that.
Yeah, that's a difficult question. So if you look at kind of, I'll pull it back to kind of OPEC, kind of OPEC core countries and kind of their view on it. It's very clear that there is a strategy that a number of countries are taking up, which is recognizing, and there is, effectively kind of the West and China are trying to get countries to kind of sign up for our quote unquote our side. And the smart move for developing countries or countries that do not have that sort is to make sure that they kind of play a bit of both sides, and make sure that they don't get themselves so in the camp of one that they lose their kind of flexibility. And so it is less, picking one side versus the other, but making sure that you kind of stay almost neutral. So some are calling it we are, to use Nehru's old comment, we are on our own side, and making sure that you don't get yourself into a spot where you effectively get run over by one of these kind of groups. And I think that's going to be important as we start to go through the energy transition, and continue to go down, and whenever we end up hitting peak coal, peak gas, peak oil, as that starts to shift, that is going to be something that a lot of countries are really going to have to wrestle with from a diplomatic standpoint, and trying to make sure that they are able to make sure that they've got the energy security, the economic security, and the trade security that they need for their governments and their citizens to still be able to thrive as we kind of go through the next couple of decades.
Absolutely, and that, as you said, that those alignments are perhaps shifting a bit, but India certainly taking a very independent stance and maintaining its relations with the West, with China, with Russia as well. Let's talk a bit about the transition. You mentioned it, and I wanted to get to it. And just a bit in the context of the US, I wanted to ask you about we have the Inflation Reduction Act being passed, and there's about $370 billion set aside, for clean energy projects within that, so for the incentives within that. But there's also a timeline for that, a decade. So how is that being received today as it's been absorbed into the market? And do you think that oil and gas producers in the US can also sort of take advantage of being part of that by accelerating their decarbonization reduction? Or is it they're still resisting? I mean, where are we at with that?
So the Inflation Reduction Act, and your numbers are about right, 375 billion, and we've already seen that U.S. companies have already committed 200 billion, because of course the whole purpose of the Inflation Reduction Act is both to inject money, but also to get companies to inject money to really accelerate the energy transition in the United States and globally, but also to position the United States so that it can be a leader in a number of different fields in the energy transition. For oil and gas companies and for energy producers, it's a fantastic opportunity, because it can take places that maybe they were already kind of thinking about from a strategy standpoint, and they can lean into them a bit more because there's a little bit more safety, a little bit more, they can see where they can get some subsidies and some sort of support for their sort of projects. And the other interesting thing is, of course, Europe was not super happy with this. They saw this as something that was non-competitive, that this was, kind of putting your thumb on the scale. And so you have seen now Europe putting forward its green development program. Other countries are also looking at doing this. So you have the UK, you have Canada, you've got Australia, Japan, Korea, all of them are looking at it. And so the interesting thing from a energy company standpoint is going to be not just understanding what is going on in the United States, but what are the other things, and how can you end up using these various policies to position your company so that you can be that leader. Right now, I'm talking with a number of oil and gas companies and others. One of the exercises I go through with them is, think through, kind of do a little bit of time travel. 20 years from now, 30 years from now, there'll be some article in the Financial Times or other that says these are the big 5 companies that really drove the energy transition. And I believe that an oil and gas company is likely, potentially 2 of them will be on that list. And part of it is because of these new muscular industrial policies that are being put in place by so far, the United States and the EU, but more will be coming.
Yeah, but I mean, and yet some would say, and I wonder who those 2 that you're thinking of, are they BP and I don't know who else, but of course, billions are already being spent by the conventional oil and gas companies on green tech, on green energy, on projects, commitments, hydrogen, CCS, etc. And yet, having seen the windfall gains that those companies have made in the last year, because of oil prices, that are receiving a lot of criticism. Some of them are like, oh, pulling back a little bit. I mean, it's not a long-term view, but short-term, they have not been sort of as committed as they were, ironically, even though the funds are pouring in.
Yeah, so and I think this is where there's often a discussion about how the energy transition will be bumpy. So it will accelerate, it will slow down. You saw even in Europe, they took kind of a half step backwards, increasing coal burn, and a recognition. I think this is a kind of arguably a growing up of the debate, which is that we need to transition, but we cannot do this by just ignoring what people actually need, which is you need reliable energy. You need to have economic growth. All of these things need to end up happening. And so that bumpy transition, companies, oil and gas companies, are dealing with that as well, because the transition is going to be bumpy, and also the beliefs about the transition will be bumpy. And what I mean by that is you are seeing some data points where fewer people are saying this is the number one thing, energy, the energy transition and climate change is no longer the number one thing. And so for companies trying to thread that line, which is making sure, okay, oil and gas is doing very well right now, but the long-term game is going to be these cleaner technologies. And so it's trying to play 2 different time horizons, which is a difficult thing to do, because the answer is not to just say we're just stopping oil and gas production when that's what you're really good at, and we're going all in on kind of the Green New Deal. So effectively, companies don't want to violate 2 different lines that I described them, and one is the line that and as a BCGer, we generally try to stay away from talking about specific companies because we like to work with everybody. But there's a company a couple of decades ago that was known where they were going to move beyond oil, beyond petroleum. And so the concern is making sure we don't want to move too fast. We don't want to be ahead of the market. We don't want to be ahead of where people are at and where the actual flows are. And the other one is what I call, you don't want to violate what I call the Montgomery Ward line. And the Montgomery Ward Montgomery Ward was a department store here in the United States in the 60s, 70s. And in the 70s, an oil company realized that it needed to diversify its income and its business, and bought this department store. Their kind of skills and their competitive advantage in terms of retail, they did not have any. And so companies are really trying to make sure, are we moving at the right speed? And while there have been maybe some doubts, the policies like IRA really suggest this is the time to move, even as you're having a very strong oil and gas kind of market right now. And you don't want to go so that you're too far away. You don't want to move away from your core set. What are you good at? You're good at, large oil and gas companies are good at project management. They're good at assessing risk. They're good at dealing with really big, complex sort of things. And that doesn't mean that they necessarily need to drill down. There's going to be a lot of things that need to take place in the energy transition, but making sure that you find something that adheres and blends with your current skill set, rather than jumping out well beyond that.
And also tying up with other companies that are developing technology for clean energy, which have had sometimes, in many cases, nothing to do with the oil and gas sector previously, but are providing solutions that they provided to industry now into this sector. Jamie, let's just talk a bit about, just while we're on the transition, we have COP28 taking place here in the UAE later this year, of course, being hosted by a country that is a significant oil and gas producer, and in a region that obviously is huge in that space. We got the usual sort of response of, oh, how can an oil economy, well, not an oil economy, but I mean an oil and gas region host COP28 when oil and gas companies haven't been welcome to previous COP meetings. But this is going to be different, isn't it? Because it's kind of making the point that we have to be part of the solution, countries like the UAE, Saudi, etc. Do you think that oil and gas companies globally will use this as a platform to really showcase the intentions that we've just sort of mentioned? And will they be welcome?
Yeah. So I think so you had COP a couple of years ago in Glasgow, and effectively the oil and gas industry was deplatformed. I remember moderating a panel in the UAE a few months after that, and I spoke with a number of very high-level people that were very frustrated because they could not get the meetings. They were not really welcome and viewed as kind of the bad actors. And then that shifted as we moved to Sharm el Sheikh. And I think this is a positive in two ways. One, and then finally we're moving on to the UAE. So a couple of things have happened that are positive in that we are what I would call kind of growing up the discussion. A recognition before 2022, when we had everything with Russia and Ukraine, there was a belief in some groups that if you just kept the oil and gas in the ground, it will be fine. And the problem was the oil and gas producers were producing this thing, and that was the problem. And so if you just kept it in the ground, everything would be just fine. And I think last year really woke up everybody's understanding, most people's understanding, that that's not the case. You really need to, this is about having demand and supply come down eventually. And so as we move into the UAE, it is an opening and a recognition that oil and gas has a role, which means that they also have a responsibility. It isn't just you get to show up because you're a major part of it. You have oil and gas companies have a responsibility to show how they're going to be showing improvements on bringing down their, accelerating their decarbonization programs. There's going to be more pressure on scope 3 and trying to deal with scope 3, which is a very difficult thing for oil and gas companies to deal with. The other aspect of moving to the UAE, so moving from Sharm el Sheikh and moving to the UAE, is this is also a bigger voice, not just for oil and gas, but for the global South. And I think too much the discussion about climate change and the need to address and have an energy transition has been too focused on the Western sort of countries. And the reality is it's critically important for the global South to be brought along. The energy, and this isn't just, there's often a discussion about the need for kind of the need for justice through all this, through the energy transition. And while that is critically important, that isn't just we should do it because it's the right thing. The energy transition does not happen if it is not a just energy transition. And the reason is because oil and gas, different countries are going to take a different strategy because they need to get the oil, gas, or coal. So the example that I would give is, we talked earlier about how Europe did a pretty good job of managing their natural gas demand and flows over this past year, but it came at the cost of some countries within the global South. Yep. Pakistan has now decided that LNG is no longer a suitable fuel for its energy security policy and is going to be quadrupling coal demand and coal-fired generation over the next couple of years. And those are not, so you can't just have a success in one region. It needs to be a global discussion. And I think this is why having it in the UAE
Mhm.
And I know there was a lot of pushback on having, an oil leader as also a climate leader. But these are my forecast is that by the end of this, a lot of people will realize, oh no, you can have an oil leader and a climate change leader. And in fact, that's preferable
Yes,
because
actually,
it gets us going.
it probably is necessary, as you said. And you used the example of the global south, Pakistan, of course, who couldn't afford, and it's in dire straits anyway as an economy. But again, the affordability of when gas prices went up. Now, at the moment, they're very much under control. But of course, we've seen LNG yo-yo a lot in the last 4 or 5 years. And what we don't want to do is encourage more coal use. So yes, the world has to cooperate and come together. Jamie, as we wrap up, let's circle back to sort of today in terms of price forecasting, oil price, not forecasting, but the trend line that we see maybe between now and the end of the year. I mean, one thing that OPEC has said consistently for the last 3 or 4 years in the way it's managed the market is we want stability. We don't want volatility. For many reasons, we want to encourage investment. And of course, in the context of what we were just talking about, it also realizes that it has another decade of really raking in these oil and gas revenues, and then we really will be in the transition, right? So they want to protect a certain price for many reasons and keep it stable. Do you think there's a price under which it will always come in from now on? Given the timing that we're at, will that be 70? Will it be 60? Or could we see lower ranges in the next few years? Come.
So it's interesting. This is there's often a kind of debate / battle between OPEC and those in the U.S. Congress that a real kind of against their moves. But actually, both organizations want exactly the same thing, which is a stable price. Now, obviously, of course, most OPEC members would like a stable higher price, and most consumers would like a stable lower price, but they all can agree on that stable price. And the issue is going to be, most likely, we are probably not going to have a stable price. And a lack of a stable price is not great for consumers or producers. It's great for traders. It's great for people who have something, because then you have something that you have to focus on and talk about. But over the next couple of years, if you look back historically at where prices have gone, I mean, they've been all over the place. And then you look at kind of the forecast, and I often tease, most forecasts seem to be about $5 away from wherever we are right now. And I think in reality, over the next couple of years, that what we've seen over the last few years is probably going to be repeated again. We're going to be dealing with some really, quite extreme volatility as you have production come on. Remember, we haven't talked about it, but U.S. shale is largely spent. It isn't going to be like it was in prior years, where it can bring on more production than all global demand growth. And so you're likely going to be dealing with a tighter market. And then eventually we are going to be moving into peak demand. And once we have that decline in demand, pricing itself will also shift, because effectively kind of the long-term price that you need is, what is the long run marginal cost of oil? And that is kind of pins where the price needs to be at. But once you head into peak demand and the demand starts to fall off, especially if the closer it gets to natural decline, is the long run marginal cost. It will instead shift to the long run marginal OPEX cost, meaning that oil prices could shift to be quite a bit lower. But at this point, oil and gas companies are trying to struggle with, when is the peak going to happen? Which means that you end up having, as we've had the last couple of years, a lack of investment relative to demand, which would augur for, relatively higher prices. But then as we finally hit that peak, we may end up moving into that lower sort of trough. And in the interim, you just look back in the last, 2 months, we've had a huge spread. In the last, couple of weeks, we had a $10 drop. So that is going to continue.
Okay, well, Jamie Webster, partner and associate director at BCG Center for Energy Impact, thank you so much for joining us today for Halftime Talk.
Thanks so much for having me. It was a lot of fun. Thanks so much.